In the world of finance, one of the most intriguing mysteries for both novice investors and curious onlookers alike is the price of a stock. How is it determined? Who exactly decides what a share of a company is worth at any given moment? The answer lies in a complex interplay of factors, market participants, and economic forces, all operating within the framework of the stock market. Today, we will unravel the intricacies of stock pricing, shedding light on the elements that drive fluctuations and the individuals and institutions that influence these prices every day. Let us begin with the cornerstone of stock pricing, the law of supply and demand. This fundamental principle of economics is perhaps the most significant determinant of a stock's price. In essence, the price of a stock is determined by how much investors are willing to pay for it, balanced by how many shares are available on the market. When more investors seek to buy a stock than sell it, the price tends to rise. Conversely, if more investors wish to sell a stock than buy it, the price typically falls. This dynamic, fluid exchange between buyers and sellers occurs continuously, reflecting a real-time consensus of a stock's worth. But why do investors decide to buy or sell a stock at certain times? This decision-making process is influenced by various factors. Firstly, there's the company's performance. If a company is doing well, generating substantial profits and showing promising growth prospects, investors are likely to consider its stock more valuable. Consequently, they might be willing to pay a premium for such stocks. On the flip side, if a company is underperforming, experiencing losses, or facing significant challenges, its stock price might drop as investors look to offload their shares. Another critical factor is market sentiment. This refers to the overall attitude of investors toward a particular market or stock. Market sentiment can be swayed by news, economic reports, political events, or even societal trends. For instance, a positive earnings report might boost a company's stock as confidence in its future profitability grows. Meanwhile, unfavorable news, such as regulatory hurdles or economic downturns, might lead to a decrease in stock prices as investors' outlook dims. Now, let us turn our attention to the role of institutional investors, such as mutual funds, pension funds, and hedge funds, in determining stock prices. These entities often manage vast sums of money and can impact the market significantly. Their strategies and investment decisions can drive substantial buying or selling pressure, thereby influencing stock prices. When an institutional investor decides to buy a large quantity of a particular stock, it can signal confidence in the company, attracting other investors and potentially driving up the price. Conversely, if an institutional investor sells a significant amount, it might indicate concerns, leading others to follow suit and pushing the price down. Technological advancements have also introduced new players into the stock pricing game: algorithmic traders. These are sophisticated computer programs that execute trades based on predetermined criteria at lightning-fast speeds. Algorithmic trading can affect stock prices by quickly responding to market changes, often contributing to increased liquidity and sometimes volatility within the market. In recent years, another factor that has notably impacted stock prices is the rise of retail investors, individual investors who buy and sell stocks through online platforms. The democratization of stock trading has allowed more people than ever to participate in the market. While each retail investor may only handle modest sums, collectively their impact can be substantial. Social media and online forums have empowered retail investors to coordinate and influence stock prices, as seen in several high-profile cases. As we piece together all these elements, it becomes clear that no single entity dictates the price of a stock. Rather, it is an ever-evolving consensus reached by countless market participants acting in a dynamic environment of information flow and sentiment shifts. Each buy or sell order, whether initiated by an individual or an institution, contributes to this complex tapestry, reflecting the collective judgment of market participants. In conclusion, the price of a stock is the product of a sophisticated dance between supply and demand, guided by a myriad of factors ranging from company performance to economic indicators, investor sentiment, and technological influences. It is decided not by a solitary entity, but by a diverse, interconnected network of investors, each with their perspectives and motivations. Understanding who decides the price of a stock offers valuable insights into the workings of the market itself, highlighting both its uncertainties and its fascinating complexity.